Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, utilities and tech are pushing stocks to new records, with the S&P 500 rising for the 8th straight session. Of course, AI remains a strong catalyst. An updated forecast from Dell and the ongoing enthusiasm from AMD's OpenAI deal continuing to propel tech stocks will bring you a few fresh picks in AI. And the shutdown impasse. President Trump sends conflicting signals on negotiating with Democrats. We'll have the latest. Let's take a look at the major averages and what we are seeing at this moment. All three major averages pushing higher to different degrees. Well, that's gold, which is also pushing higher. But let's take a look at the Dow. Right now, it's only up by about 2 points. So kind of looks like flirting with the unchanged line and actually just flipping into the negative. So the rally continuing, but not necessarily continuing with the same kind of momentum here. The S&P 500 up very slightly as well, not even 0.1%, but the NASDAQ up 0.1%. Also, the S&P and the NASDAQ touching new records here. The Russell 2000 of small caps has also been setting new records, finally joining the party of the larger caps. Now, we were just looking at gold, so we might as well go down and take a little gander there, because gold above $4,000 an ounce and continuing the rally we have seen there. So even as you have sort of the risk on participation from equities, you also have people going into gold, which has been interesting. Bitcoin pulling back a little bit from its record levels. Large cap tech continues to be a big part of this story, obviously. It's a little mixed here today. You've got Nvidia rebounding from losses yesterday. After AMD signed that deal with OpenAI, we saw a little bit of weakness in Nvidia, but it is coming back here today. And by the way, AMD now up for the second day in a row. So the momentum continuing over the enthusiasm with that deal with OpenAI, up 30% over the past couple of days. And then we saw the Dow sort of flirting with the unchanged line here. And you can see here the mixed picture that we're seeing as well. Stocks like J&J and Walmart feeling a little weakness. Sector-wise, as I mentioned, utilities up 0.2%, tech up as well. That's leading gains, even as you got consumer discretionary and energy kind of weighing things down at the moment. So that's the big picture for what we're seeing for the markets at the moment. Let's move on and talk about what's going on underneath the surface of the markets now. The S&P 500 and NASDAQ both on their way to notching their second record highs this week. On an intraday basis, we'll see if they end up closing there. It's good news for many portfolios, but is now a good time to maybe take a step back, sell, lighten up? My next guest says beneath the euphoria are signals flashing that it might be wise to have an exit strategy. Chris Watling is here, Longview Economics global economist and chief market strategist. Chris, you guys, like many firms, look at potential sell signals, signs of the market getting overstretched. What are you seeing right now?
Yeah, we like to try and get out of the way of these pullbacks, the one or two pullbacks you get every year. And I think what we see at the moment is a market that's running extremely hard since the April lows. And it's starting to look very speculative, very frothy, very greedy. And that's generally the kind of setup you get before you get a pullback. It's difficult to know exactly what the trigger is, but you look at the sort of level of single stock call option buying, it's way above records, above highs we saw in the pandemic, ahead of that 2022 bear market, and above what we saw in prior spikes. So, you know, there's clearly a lot of speculative froth out there. We saw the way a lot of these stocks behaved in September. Oracle, the sort of poster child, adding 300 billion in market cap in a matter of days, trebling its market cap since the April lows. And there's a ton of big cap stocks like that. So it's not just big cap, small cap, but it's also big cap getting caught up in the surging. And actually, frankly, it's broadening around the world. So whenever you get that vertical FOMO, vertical price action, everyone's getting sucked in, shorts are getting squeezed, and the market's suddenly got no downside protection. So it's very vulnerable to pullbacks.
So we were looking at your chart in your most recent note of sort of the times that you've seen the sell signals according to your calculation. So we're not quite there yet on this calculation, but what would get us there? What are you watching for that could be a potential sell signal?
Yes, so this is one of our key models, but we have a number of key models. It's very near quite a toppy level, which is telling you the market's greedy, and about there maybe could get a little bit more greedy, but not much. So what we're really looking for is a market that shows evidence of being tied to the upside, or a market that suddenly cracks. That tends to be the final piece of the puzzle. It could be a bit like DeepSeek back in February, a bit of news flow, then everyone changes perspective. Or markets sometimes just roll over through rally exhaustion. And, I think in the last few days, the market's looked a bit tired. It's eked out at 0.1 or it's down 0.2. It's not done much. And actually some of the defensive sectors have done a little bit better. That's normally a bit of a troubling sign. So I just think, I'm not suggesting the bull market's over for good, but I think if you can get out of the way of pullbacks, and stocks have gone up a lot, will go down the most in the pullback. If you can get out of the way of that, you can actually save yourself a lot of gains, book some gains and get back in at a better level.
It's really interesting because we've been talking to a lot of folks who say, maybe stocks are getting valuations are getting a little toppy. There doesn't seem to be a lot of alarm out there. Even people who are using the bubble word don't seem overly concerned. What does that say to you?
Well, in one sense, it makes me more worried. I mean, people are, once everyone's sucked in and everyone's stopped calling it is what it is. But there are definitely people calling it a bubble. I think the most troubling aspect about this is the short capex cycle you have in the processors. So you've got 2-3 year capex cycles. These hyperscalers got to earn their money back in. I don't know how they're going to do that because there's a ton of supply of this stuff. And yes, it's going to be amazing and we all love AI. But just like in .com in 2000, the stocks peak and then the technology is great for the next 20 years.
Right.
So, I think one parallel for me is this is possibly a bit like the second half of the 1920s. And I don't know how well you remember that. 1925, Florida had a housing boom and then a housing bust in sort of 26, 27. Florida house prices at the moment are now 6% off their peak. It looks like it's going into a housing bust. Now that, of course, encourages more rate cuts from the Fed. It's not just Florida, there's a few other states around there. Texas is a bit toppy as well. And that gives you liquidity to drive the market for one more flush to the upside. So we could have a bit of a broadening globally, cyclicals and everything getting sucked in, a big rally, blow off top.
Yeah, well, and it could last a while because the Fed is only really, they're closer to the beginning of their rate cutting cycle probably than the end, right?
Exactly. In fact, globally, everyone's cutting rates. If you take 90 central banks around the world, 90 central banks, every month in the last 12 months or so, net 15 to 20 of them have cut rates. So basically no one's really raising rates. Most of them are cutting. So that is a ton of rate cuts going out there. The Fed's now getting back into the party. And maybe it isn't quite 1999 yet. We're not partying and we're not quite there as you were saying earlier. So you could see maybe one more flush to the upside. But but for now, I think the market is looking quite vulnerable short term. And I like to remind people that even in 1999, from July to October, the market sold off 12.5%.
So what do you do? Do you sort of stay in stocks but also buy downside protection?
Yeah, it really depends on your time frame, how nimble you like to be, but you could do all of the above. You could take a bit off the table, you could raise a bit of cash so you got something if it sells off. You could buy a bit of downside protection. You've got to be put options. You need to be agile, but and I think cash on the sidelines to put to work in the pullback is perfect. And one of the things I said is I think this market's broadening globally, so there's opportunities elsewhere. The dollar's a weak currency, and so on.
And we've heard some more talk about places like Japan. Also, we saw the big rally there after.
Great move on Monday.
Election.
Exactly. And that's actually in a very interesting market. I think Japan. Look at some of the commodity markets. Some of the base metals are quite interesting. Some of the commodity countries like South Africa, Chile doing. It's a bit beyond people's normal remit, but I think globally the market is broadening out.
Yeah, well, definitely international has been one of the places to be this year.
Yeah.
Thanks, Chris. Good to see you.
Thank you.
Coming up, a wave of AI deals pushing stocks higher, why it's raising concerns of a bubble. We're going to talk more about that. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. Let's kick things off with AMD. Shares extending their gain after Jefferies turned more bullish on the chipmaker. The firm upgrading shares to buy from hold and boosting its price target to $300, a share that's nearly 50% upside from Monday's close. call comes on the heels of that new OpenAI partnership, which Jefferies called a, quote, strong validation of AMD's AI roadmap and a signal of just how deep demand runs for these advanced chips. The firm estimates this deal could generate over $100 billion in revenue from OpenAI and other customers over the next 4 years. Next up, Brinker International, the company behind Chili's getting a lift from JP Morgan, the bank upgrading the stock to overweight from neutral, calling valuations too low and saying investors are too fixated on short-term difficult compares. JP Morgan making the case that Brinker has what it takes for Chili's to recapture decades of lost traffic and drive a longer-term turnaround story. Shares are down about 4% since the start of the year. And finally, shares of Dollar Tree falling this morning after Jefferies cut its stock rating to underperform from hold, citing a tougher landscape for the discount retailer. The analyst said inflation, management decisions, and new tariffs have turned a simple business model into a complex one. Add in rising competition from Walmart, and margins look set to stay under pressure. Well, that's it. Keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching AppLovin, Alphabet, and XAI. First up, AppLovin. Those shares sharply rebounding. They fell 14% on Monday after Bloomberg News reported the SEC is probing the data collection practices of the mobile advertising technology company. The agency specifically looking to allegations that AppLovin violated service agreements with platform partners to push more targeted advertising. But Citi analyst Jason Bazinet notes the regulator has not officially accused the company of wrongdoing. He views the absence of an 8K filing as a positive. It suggests the firm, he says, does not view this as a material risk. The shares up nearly 7% today. Next up, Alphabet. Its Google lost a Supreme Court bid to pause major changes to its Google Play App Store in an antitrust case filed by Fortnite maker Epic Games. The Supreme Court, without explanation, denied Google's request to temporarily put part of a lower court ruling on hold. The company sought to block a requirement to allow rival app stores access to its app library and bar it from blocking downloads of competitors in Google Play. A Google spokesperson said the company is disappointed by the ruling and will continue to appeal. And finally, XAI, Elon Musk's XAI startup, appointing a new chief financial officer. The Financial Times reporting Musk tapped former Morgan Stanley executive Anthony Armstrong to take the helm as CFO at both XAI and X, the social media platform. The executive previously helped Musk complete the $44 billion acquisition of Twitter and was one of his lieutenants during his stint at Doge. Armstrong's predecessor left the company just months into the job. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. The recent AI deal spree pushing stocks higher, and the latest AMD is the latest company to announce a partnership with OpenAI, with the AI startup signing a total of $1 trillion in deals this year. Joining me now, Ivana Delevska, Spear Invest founder and CIO, which takes a deep dive into and invests into these kinds of companies. Ivana, it's good to see you.
Great seeing you, Joe.
So we had AMD signing that deal yesterday. This morning we have Dell out with an updated forecast. We have IBM signing a new partnership with Anthropic. There is just still so much activity in this space. You know, how much can this momentum keep going?
Well, Julie, I think we're at the beginning of a new wave of investments, and I think this is what's driving that. The first wave was mostly infrastructure going into existing data centers, so it would be NVIDIA's Hopper GPUs going into existing infrastructure. Now we're going into the next wave where we're building out new data centers. This is significantly more dollars, and that's why companies have to partner with other companies and take us through the next wave.
Do you think OpenAI itself still has a lot of these deals to sign? And if so, where will be its next areas of partnership?
So for OpenAI, there are two types of partnerships they're pursuing. One is on the technology front, and then it's on the investment front. On the technology front, they've now partnered with, we saw AMD, they partner with NVIDIA, and they also are doing custom chip with Broadcom. So I think they're pretty well covered on the tech front. However, they do need to invest significant amount of CapEx in order to get these projects rolled out. So we expect more partnerships on the investment side. So we think they're going to be bringing new investors to the game.
Interesting. So not necessarily other tech companies, or maybe in some cases tech companies, but just big investors to help fuel the spending that they've been doing.
That's right. That's right.
Interesting. And from an investor perspective, from an individual investor perspective, is there a way for folks to continue to play this? Where are we going to see the next sort of wave of activity if what you're saying plays out?
So what we're seeing, Julie, now is that the key will be performance improvements. So what we're looking at is where is this performance improvements going to come from? It's not going to come from the chip because the chip is quite well optimized. So the areas that it can come from is either on the networking side, it will be on the power supply, power generation side, and thirdly, it will be between the software and the hardware integration. So this is why you're seeing deals like OpenAI with AMD, OpenAI with Nvidia. They're trying to the companies themselves are trying to come closer to the hardware layer rather than using hardware from a hyperscaler.
Interesting. Okay, so let's break this down a little bit and try and, we've talked about networking before. I've heard Nvidia talk a lot about networking. What are we talking about when we talk about networking? Is it, the sort of chips talking to each other in the data center to optimize performance, the data centers talking to each other and talking to the cloud? Like, is it all of the communications between all of this?
That's right. It's basically all of the above. So there is an area within the chips that NVIDIA is particularly strong at that's called scale up. There is also scale out, which is data centers talking to the outside world and talking to other data centers. So this is basically a pretty broad opportunity set, and there are different players in each sub-segment, whether it's scale up or scale out.
So where are some of those places that investors should be looking?
So we really like some of the smaller players like Astera Labs and Credo Technology, and also Arista Networks is one of the larger players that is really strong on the scale outside. So there are different companies playing in different places. I think the key is going to be that this is where the performance improvement is going to come from, and specifically when you see deals outside of NVIDIA, like companies like AMD doing well and Amazon doing well, this is particularly good for the networking layer because NVIDIA does a lot of their own versus everybody else uses some of these third parties.
Ivana, what about this whole argument that, A, valuations are getting stretched, and B, this sort of circular, NVIDIA invests in OpenAI, OpenAI buys NVIDIA chips, and oh, by the way, also signs a deal with one of NVIDIA's rivals, AMD. Like, what do you make of all of those?
So we've never seen this level of investment before, right? We've never seen this level of requirement in terms of CapEx investment. So I think this is why you're seeing partnerships as the only way to go. NVIDIA has been supporting the ecosystem for the past 15 years. So even before ChatGPT came out and before the transformer model came out, NVIDIA has been pretty heavily investing in educating companies and teaching them how they can use the chips and how they can develop AI. So it's not completely surprising that they would keep doing this now with bigger dollars, right? Because they are generating significant cash flow. So I think the circularity goes from the fact that we do need to put significant dollars to work and no one company can do it on their own.
Do you think there's risk inherent in that, though? If the whole ecosystem is so reliant on each other to succeed, if there's one area of weakness, could that sort of bring a lot of weakness and vulnerability to the whole thing?
Well, I think it's almost the opposite, right? Because now you're seeing the value chain kind of broaden out, right? So it's not just NVIDIA carrying the torch, it's a whole, you have the hyperscalers, you have all of these suppliers to the hyperscalers. So it's really broadening out from like last cycle, it was just literally NVIDIA supplying GPUs to existing data centers. Now it's an entire ecosystem, whether you're looking at the companies using them, whether you're looking at the companies providing the picks and shovels, it's really broadening out.
Interesting. Ivana, great to see you. Thanks for coming in. Appreciate it. Well, coming up, as the government shutdown stretches into its 7th day, what could finally get the needle moving on negotiations? We'll discuss next. The U.S. government shutdown is now approaching a full week. President Trump saying on Truth Social, quote, "I'm happy to work with the Democrats on their failed health care policies or anything else, but first they must allow our government to reopen." Meanwhile, Senate Minority Leader Chuck Schumer pushing back on the president's comments, writing on X, quote, 5 failed votes by Senate Republicans. They should know they can't go forward unless we come to an agreement to address the healthcare crisis in America. Here with more on how the shutdown could potentially end, Ed Mills, Raymond James Managing Director. I guess it tells us something they're still communicating via social media because the in-person meeting they had last week did bupkis, Ed. So, like, what's going to change at this point?
It's a technical term.
Yeah.
Yeah, I think what we're at right now is a standstill. We do probably need someone to make a political mistake. We need some movement in the polling data. What we've seen previously, it's taken the country to decidedly blame one party or another before it opens up. And we probably need to get to a missed paycheck, or maybe at the end of the month when people aren't able to make their rent payments, their mortgage payments, the kind of monthly bills, before there's pressure that truly builds to get this government reopened, Julie. There's not a lot of progress just yet.
So that makes it sound like you think this is going to keep going. This is not going to be a short-term shutdown.
I do, because we are not in a normal playbook. What we've told clients here at Raymond James is that in previous shutdowns, we've seen the party that brings you into the shutdown get blamed for the shutdown, and that they have to reopen the government without getting anything. The big difference this time has been the fact that it was Democrats who are denying the votes and has led to the shutdown versus Republicans denying the votes leading to the shutdown. So we don't have that normal playbook at the front and center. It is not quite clear, kind of, if you even just agree to negotiate, whether or not that's going to turn the government back on. I do think that Democrats are pushing to have a more, quote unquote, ironclad agreement to get this reopened. So when you don't have the traditional off ramps and we're in a year where the traditional playbook does not apply, it's really hard to see exactly how this ends.
And also, you know, I suppose at other times it's always busy. There's always other things going on in Washington. But right now, the administration is fighting battles on sort of an extraordinary number of fronts in terms of the administration trying to send, for example, the National Guard into various cities, lawsuits fighting that, a number of, you know, there's a lot going on. And so when you talk about the polling data, is it tough to sort of isolate sentiment around the shutdown from sentiment around everything else and who's getting blamed for what?
Yeah, Julie, that's an important point. One thing that we've said is a key theme for this year is the use of executive power by President Trump, and just how much he's willing to push on that executive power, how much Congress or the courts check that executive power. And we've seen kind of the president use that executive power when Congress is not in session or kind of has not had that check. So we do see a number of geopolitical issues that are out there that are capturing headlines. We're seeing those domestic issues, as you mentioned, related to the National Guard. We have a tariff battle that's ongoing. Later this month, President Trump is sitting down with the leader of China, Xi. So kind of to the extent that this government shutdown doesn't dominate the daily news, I live in the Washington, D.C. area, and you know it's impactful to kind of friends that I have and neighbors that I have, but I don't see this around-the-clock coverage. It's almost as if something that used to be kind of the stop the presses moment has moved into this, yeah, it's just something that's going on in the background. Kind of government services are functioning. The mail is going. TSA is operating. The military is operating. So what is that forcing mechanism, Julie, that gets us back on? I have not yet seen it, and that's where I kind of will probably, wherever you give me the timing, kind of so far take the over.
Right. And as you said, you know, once you start to see those missed paychecks, maybe the TSA situation worsens, for example, maybe that's the tipping point. The other thing going on in the background is also still the tariff negotiations. You mentioned that President Trump's going to be speaking to President Xi. There might be some kind of also agricultural relief bill that could be signed, or not a bill, EO, I guess, signed soon. So, you know, how is that affecting the chatter in Washington also? And again, the sort of polling data and the perception of what's going on.
Yeah, so I think pretty quickly we're going to be all focused on what's coming out of this meeting between President Trump and General Secretary Xi. Our view is that semiconductors are at the forefront in terms of what China wants. Agriculture products, soybeans is on the kind of ask of the United States. I do think one of the themes that we've highlighted for the last couple of months here at Raymond James is, from a market perspective, the fact that the United States and China is at a bit of a detente, that has been part of this positive backdrop. We've had the government shutdown kind of provide that headline risk, but what we told folks at Raymond James is during every last shutdown, we've seen the S&P 500 go up on average of more than 3%. So we have not seen the negative market reaction. As we get to the end of the month with these announcements, if there is a major breakthrough with China, if it doesn't seem as if these tariffs are going to come back on, that could be the next leg up in this market, especially if there's a view that they could be buying more semiconductors that we thought were off limits, or semi-cap equipment, because we've seen technology lead this market. In the Trump 1.0, we had to get used to this idea that these semiconductor restrictions were pretty tough. This time, it does seem as if they're much more kind of open to negotiation, and that national security and economic lane are merging. And if they do merge, what China can purchase is quite considerable.
On the flip side, Ed, what would be the sort of counter to that in terms of, not necessarily from tariffs, but what would change in the shutdown equation that could make it negative for markets? I mean, would it be if the administration attempted to more permanently fire folks, or does it not matter to the markets no matter what?
Yeah, it matters over time. So when we look at a number of the projections out there, you do have a pullback in some consumer spending. There is a view that this could be somewhere between 0.1 to 0.2% of GDP per week. So as you get more than a couple of weeks, if we're going beyond a month, that's when the economic kind of worry comes in and saying, hey, is there going to be a hit to GDP that we didn't anticipate? Because the longest shutdown previously was for 35 days. It was 22 trading days, but the government was partially funded there, so it wasn't the full impact. So to the extent that there is that fiscal drag because the government's not buying things, because government workers are not getting paid and are not spending money, if it goes more than a month, then I would say the market kind of pays attention to that. But on the other hand, we're getting a lot of questions on what will the Fed do. We don't have a lot of the traditional data that we kind of rely upon for the Fed to conduct monetary policy. So if there is a prolonged shutdown, we don't have that data. I think the market expectation is that the Fed will cut more aggressively, or at least follow through with what is planned. And in that sense, that provides a little bit more of a cushion to the market versus kind of if we're in a status quo environment. So to me, the bias is to the upside. There's always risk to the market. But I've told folks at Raymond James, don't take these headlines and kind of be the thing that gets you panicked. These things are usually things that work their way out in the rearview mirror. 30 days post shutdown, almost every single shutdown, the market is also up during that time period. We're going to that year end period, usually historically a pretty decent seasonal time for this market.
Ed, great to see you. Thanks so much.
Thank you.
Much more markets action coming up. You're watching Market Catalysts.
Quantum stocks ripping higher. Names like IonQ, Rigetti, and D-Wave all surging double digits over the past few days as investors pile into the next frontier of computing. For more, I want to bring in now David Williams, Managing Director of Equity Research in Semiconductors at Benchmark. David, great to see you. So let's talk about this move in quantum stocks here. I'm just looking at an ETF that tracks the space, the QTUM. That's up nearly 40% this year. It's up nearly 20% in just the past month, David. What broadly explains this excitement?
I think there's a lot of different drivers or catalysts for this, but some of it is simply just the investors that are warming to the idea, that are getting up to speed, and the inbound interest for quantum has never been stronger, even the last 2 to 3 weeks. And so there's a sense that it's almost a ChatGPT moment in quantum where you don't want to miss that investment before it begins. And so I think everyone is looking for some way to play AI and in quantum, and that's what's really driven these stocks more recently.
David, how you think about the commercial quantum computing market? How big ultimately do you think that market could be?
It's quite sizable, and the estimates are kind of all over the place. It's hard to really tell today, just because there's so many applications. We're still trying to discover where quantum could be useful. But if you think about quantum sensing and quantum networking, and then quantum computing, it's multi-billions and even into the $100 billion, depending on how you look at that space.
What are some examples, David, some use cases, that are live right now that you find particularly, impressive?
There's quite a few, and we're still in the early days, but these machines are still quite capable of producing results, especially on the research side. A lot of chemistry and biopharma, even in drugs, pharmaceuticals. So we're seeing some real nice responses there, some increases in speed, and really unlocking some new, what we call a quantum advantage, doing something that can't be done with classical systems today. We're still a long way away from having them really interface day to day in our work, but they're getting very close. And if we look at D-Wave, they have a really interesting application in a logistics scheduling platform for a grocery chain in Canada that has found some pretty impressive results. And so it even goes to show that quantum can play out in everyday applications.
Not everyone, David, obviously follows the space as closely as you. Can you it might be helpful, just take a beat, remind us the basics of quantum computers and how they're different than supercomputers?
Yeah, it's really interesting. Quantum computing at its core is nothing more than a typical system. The only thing really quantum about it is at the chip level. So it's at the atomic level that makes it a quantum computer. And so it's using basically the natural states of physics and quantum to make calculations. And it does this in a parallel fashion as opposed to in a logical sequence like we see with a CPU. So it operates much more like a GPU in some regards, but it gives you this ability to do many, many calculations simultaneously as opposed to one step after another.
I want to get to some picks. Before that, David, I'm also just curious about geopolitical competition here. What is your sense of who's in the lead when it comes to this field? Is it the U.S. or China?
It's definitely challenging to see, and we spend a lot of time in this area. We think that the U.S. has a very commanding lead today, but there's also things that concern us are the ones that we don't know about, the ones that aren't as in the market or open about their capabilities. We do know they're making some really nice progress, and China is spending significant dollars in investment on the quantum computing space. But my suspicion is that the U.S. is still leading in that regard, and we need to make additional investment to ensure that we stay in the lead.
What about big tech's interest and excitement in this space as well, David? You think of Amazon or Nvidia? How, if at all, does that change? Does that affect the broader quantum computing landscape?
Yeah, it's really interesting because I think that there's an opportunity we talked about AI earlier, but having an opportunity for AI to really accelerate quantum and for quantum to accelerate AI. And so they're very complementary relationship there. And over time, I think we'll see more and more of that. And we're starting to see the realization, I think, even of big tech, that is capable and possible. And perhaps that we're closer to quantum advantage than many had previously anticipated. I know that Jensen Huang from Nvidia several months ago had talked about quantum being many, many years away, and he has since changed that tune a bit. But we know that we've got D-Wave and IonQ and Rigetti that are proving really close to being to quantum advantage, and we think the next couple of platforms will really prove that out.
You mentioned IonQ there, David. I know you tell your clients that's a buy. How come?
We like the really well-developed business model. They're participating across all things quantum, whether it's sensing, networking, or compute. We think their platform is making some really great strides, and the leadership team there has done a phenomenal job. They've also got the balance sheet to really support the continued R&D investment. And so they've got a really nice lead there, and we like that approach. We think there's also other opportunities in the space. And what we've been telling investors is that regardless of where you gain your exposure, these stocks really tend to trade in tandem with one another. So you need exposure. Picking the winner is not always the easiest case, but I think any exposure in the space will be a winning bet, at least for the near term.
You mentioned other names as well. What about Rigetti? Is that another name you'd be recommending?
Yeah, absolutely. I think Rigetti's got an incredibly strong patent portfolio. They've done some really great work on the superconducting side, which is really the most mature platform. We like where they're at. We think that they're making some really great progress on the fidelity side and across their entire platform. So yes, we do like Rigetti, and it's a name that we'd certainly want to own.
Finally, Dave, before I pile into these names, Rigetti or IonQ, what do you tell your clients some of the broad risks I need to think about are?
I think the bigger risk, obviously, is we're in a momentum area today. I think where the stocks are playing out. And so valuation is one of those things that's very challenging at the early stage when we've got minimal or de minimis revenue. So it's not really about what we think the revenue is going to be this year or even next. We're looking out well beyond that to try to understand where this valuation could play. I will say that in momentum stocks, we've never seen valuation alone really change that momentum. It usually requires something in addition to that. It's either sentiment changing or a rotation, a broader rotation that causes a momentum stock to really begin to go the other direction. And so with all the inflow that we're seeing here, whether it's from ETFs or retail or even on the institutional side, we think there's still a lot of momentum left in these names.
David, great to have you on the show today. Thank you for your time
Absolutely.
and those picks.
Shares of the company behind Modelo and Corona beers, Constellation Brands, rising after topping Wall Street's estimates in its second quarter as beer demand remains steadier than feared. The company also reiterating its lower full-year guidance it issued last month, citing the challenging macroeconomic environment. Joining us now with an analyst take on this report is Filippo Falorni, Citi's Vice President of U.S. Beverages and Lead Analyst for Home and Personal Care. Filippo, it's great to see you. How would you characterize how Constellation is doing? Because it doesn't seem like it's doing great. It's just not doing worse than anticipated. Is that fair to say?
Yeah, absolutely. Thanks for having me on, Julie. Look, the quarter was pretty much in line with the expectations on the top line. Depletions were down, which is a measure of volume. We're down 3%, 2.7 to be exact. And that included a decline of almost 4 points in the on-premise channel, so bars and restaurants. And that's really the channel where they've seen more of the impact of the Hispanic consumer weakness, less social interactions. And then in the more at-home channel, they've seen a decline of 2.5% in volumes. So look, to your point, it's not great results, but it's probably better than feared. The stock already took a pretty significant negative reaction after they lowered the guidance, as you mentioned, in early September. So I think the expectations were already pretty low, and they came in about in line with what the market was expecting.
Well, I guess, Filippo, my main question for Constellation is, are its issues out of its control or in its control? And how's it doing with the things that it can control?
Yeah, no, that's a good question. Look, I think a lot of it is really this global social political environment, particularly how it's impacting the U.S. market and the Hispanic consumer, the core Hispanic consumer base. The company does like kind of like a quarterly omnibus study in terms of survey work with the Hispanic consumer base. That's about 50% of their consumer base. And based on this study, they're seeing that over 80% of consumers are worried about the socioeconomic environment in the US. And over 70%, they're particularly worried about their personal finances. So clearly the environment for them, it's really challenging, again, given over 50% of their consumer base is Hispanic consumers. And really what they're trying to do is really focus on their core brand, right? The Modelo Especial, the Corona Extra, try to launch innovation. But obviously the environment is not easy. They're still gaining share within the US beer category, but to a certain extent, the share gains have clearly decelerated versus prior years.
So we've been talking about beer. There's also the question of what's happening in the wine and spirits category. They saw a big year-over-year decline, but that's because they also got rid of some businesses. So, but still saw a decline, even if you take that out. So that doesn't seem to be the sort of Hispanic market issue. So what does that have to do with?
Correct. The wine and spirits business is an area where they've been trying to diversify their portfolio in the sense of divesting the more mainstream brands, which have been declining by the larger amount, and they're focusing on the more upper end, the premium side of the portfolio. That part is doing still relatively better. But look, the wine and spirits category is clearly being under a lot of pressure. Overall alcohol consumption in the US has been coming down over this year and the past couple of years. So they do have pressures there as well. I would say they're trying to do the right thing from a portfolio standpoint, focusing on the part of the portfolio that are growing, but there's still quite a bit of more mainstream and lower income kind of exposure in some of the wine and spirits business that is declining still significantly.
And so I know you're neutral on this name. I mean, should investors sort of not really focus on anything alcohol related in this environment?
Yeah, look, our call has been more cautious on the alcohol category for 2025. We've been much more bullish on the non-alcoholic beverage side, especially in energy drinks, where you're seeing a lot of growth. In alcohol, you're really seeing decelerating consumption levels across the U.S., across different demographics, including Hispanic consumer, but also younger consumers. There was a Gallup poll a few months ago really suggesting that alcohol consumption has really been on the decline significantly for the past 2 years. And if you look through the survey results, it's really more pronounced in the younger consumer demographics. So clearly there are some concern about more structural issues for the alcohol category. And on top of that, for Constellation, the Hispanic consumer pressure has been really more than the industry given their higher exposure. So we downgraded the stock in March of this year because we thought the environment was going to get too tough for them to really continue their growth. Because prior to that, for the prior decades, from 2014 to 2024, they really had phenomenal volume growth, right? This was a company that was growing volumes at a high single-digit rate, and now they're declining more in the low single digits.
Well, I do want to ask you, Phil, about one of the biggest holders of the company that's been adding consistently is Berkshire Hathaway. And so sort of stepping aside from the sort of short to medium term outlook, we know Berkshire looks at the long term. Is there a long-term case to be made for this stock?
Yeah, no, look, it all depends on your time horizon, I would say. Our concern when we downgraded the stock was that this really socioeconomic environment, which is unfavorable for Constellation, could really last for a couple of years. So we were worried that, this was a company, again, coming from a decade of high single-digit growth, and so the market needed to reset to a much lower medium-term growth algorithm, which then the company cut its long-term algorithm in April of this year. So if you take a little bit of a longer-term view, like a 5-year view, call it, then you could argue, okay, some of this pressure among the Hispanic population will be generally more transitory, and this is still one of the fastest growing population within the US. And so if you take that longer term view and you say, okay, there's been a particular negative period of time where Constellation was impacted, on a more normalized basis, the company could return to positive growth. But I do still think the level of growth that you saw in the prior decade, the high single digits, seems very, very challenging to reach at this point.
Filippo, thank you so much for your analysis. Appreciate it.
Thank you.
And for more on Constellation Brands business, you can stay tuned to Yahoo Finance. Tomorrow, we're going to speak to the CEO at 9:30 a.m. Eastern. Bill Newlands will be joining us. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Up this hour on Market Catalyst, we'll hear from AMD CEO Lisa Su on its blockbuster deal with OpenAI. Plus, gold tops $4,000 an ounce. We'll dig into the drivers behind that record rally. And we'll hone in on the crypto rally as well as the debasement trade, as it's being called, gains traction on Wall Street. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here, taking a look at the major averages. All three are now in the red after starting off the day on the up and up. We've got the Dow off by 66 points, the S&P off about 0.1%, as is the NASDAQ. So a bit of the pause in the upward momentum after 7 straight up days for the S&P 500. And AMD is continuing to rise after announcing a multi-billion-dollar partnership with OpenAI. Yahoo Finance executive editor Brian Sozzi spoke with AMD CEO Lisa Su for more details.
It's always good to see you. You never cease to amaze me on these deals you strike and what you've been doing here at AMD since you joined many years ago. Congrats on this news. For investors, not familiar with precisely what you announced. I'm taking it as OpenAI, AMD are working together to build the future of AI infrastructure. How do you see it?
Yeah, well, first of all, Brian, it's great to be here with you. And yes, today is a big moment for us, a very exciting deal. You know, when you think about where we are today, it is all about AI and how do we use AI to really impact every single industry out there. And the foundation of that is you need to have enough AI compute. And so, yes, what we announced today was a 6 gigawatt deal. It will be, tens of billions of dollars of revenue to AMD over the next few years. And it's really an opportunity for us to even partner deeper with the clear market leader in AI. And so we're talking about building 6 gigawatts together. The first instantiation will actually go into place the second half of next year. We see it ramping to double-digit billions of revenue for us. It's incremental from an AMD standpoint, and most importantly, it actually has us working together on the technology, because the technology is just super hard. There's so much we have to do to get it all working, and so bringing the best of OpenAI and AMD together is what this deal is all about.
A deal like this, Lisa, it doesn't happen overnight. You didn't wake up Sunday thinking, all right, we're going to announce this on Monday. When did you start working on it? And what was it like working with a Sam Altman to get this through the finish line?
Well, the key, Brian, and I've told you this before, the key in our world is it's all about roadmap. It's all about the technology. It's all about ensuring that we're meeting the performance capabilities for the most demanding foundational models. And that's what OpenAI has. I mean, they have brilliant engineers. Their models are used everywhere. And so this has been a process. It's been, several years in the making. It started with them testing our MI300 and doing some early work on MI300. That moved to MI350. We've done a lot of work on software. And, it's culminating in, they've given us feedback on what they believe best in class is. And MI450, which we have coming next year, is absolutely that. It's best in class, AI computing. And the fact is, having a team that is so much at the center of the global AI build out, being super excited to be a lead customer for MI450, I think is a great thing for us. It'll push us to get the technology out even faster. And it's been a couple of years in the making, but we're super excited to be able to talk about sort of the breadth and the depth of this relationship, as it relates to our overall AI capabilities and AI business.
Lisa, I'm trying hard to make sure I got all these terminologies down correct. So bear with me if I get one wrong. So what would deploying 6 gigawatts, how does that change the future of AI, and what does that mean to the average person who's only now starting to come across AI agents on various platforms?
Well, Brian, it's a great question. I mean, I think we've all experimented with AI. People, think about ChatGPT and Gemini and asking it questions. But what we're seeing is this is really only the very beginning of people taking AI and using it for improving businesses, for improving research, for improving, all kinds of capabilities. And what we see is, to get more capability, you need more compute. So the work that we're doing is building the foundation of this AI world. And what we want is to make sure, like, every time you have something that you want to use AI for, there needs to be able to have enough compute on demand. And that's why we're talking about building multiple gigawatts. I mean, it is, once you build out all 6 gigawatts, I mean, you're talking about millions of GPUs. And that millions of GPUs will go towards every user having, sort of intelligence at their fingertips.
How difficult is it to build out this type of infrastructure?
It's incredibly difficult. Let me say, Brian, it is incredibly difficult. But we have been working on this for years. And, sort of our technology is really around the chips, about ensuring that, we are constantly looking for pushing the envelope on sort of the next generation. So we're really excited about our MI450 generation. It has 2 nanometer technology, so the most advanced fabrication capability. It has, rack scale solutions. So we're really putting all all of these compute elements together. And the way to think about it is it takes a village to build this all. So we are of course very proud and focused and dedicated on our piece of it, but it's us, it's our cloud service partners, it's obviously OpenAI and the model users. We all need to come together, plan this infrastructure together, make sure there's enough power in the world for all of this AI compute. And once we put it all together, we deliver just, fantastic capability to the world.
Is there enough power?
There is not enough, but we are actively building everywhere. I mean, this is, all about ensuring that there's enough power, certainly in the United States. I think there has been tremendous focus by this administration of ensuring that AI is top of mind, and that's super important. It's ensuring that we have enough manufacturing capacity to do this. It's all of the above. And so I would say that the industry is coming together. I mean, this is one of those points in time where you need every part of the food chain to come together and say, we want to do this. We want to build fast. We want to build big. And we're all putting our best efforts, towards this big vision.
So much has happened since I last talked to you, Lisa. I mean, of course, this deal is very much front and center. We have the U.S. government now has a stake in Intel, which wasn't on my bingo card coming into this year. Some would say these tie-ups are causing risks to the AI industry or even the tech industry. What do you say to those critics?
Brian, I would say that that's probably thinking too small. You have to really look at, what the power of this technology can do for the world. And if you think about all of the applications that can take advantage of AI and computing and, sort of the massive investments that will have, significant returns on the other end, it takes time to build all this out. So yes, we are investing heavily. Some might say investing ahead of the curve. I actually say investing at the right pace because we want to accelerate. This is a place where when companies and partners make bold moves, it will be rewarded because we will do things that you previously thought weren't possible. We're actually bringing the industry ecosystem together so that we're actually getting the best of each of our teams so that we can actually accelerate the rate and pace of deployment and AI innovation. So, I really believe that this is the beginning of a 10-year kind of super cycle, and we're in the very early innings of this. I think, Brian, I used to say that I thought the AI TAM just for silicon accelerators, sort of our piece of the business, was going to be, $500 billion. And some people thought, boy, that was a big number. And now maybe I've underestimated that number. And we have a lot of clear, demand across the world, for this infrastructure.
Coming up, we're hearing from a fourth-generation farmer about a potential bailout for his profession. We'll be right back. The White House is reportedly considering between $10 and $14 billion in funds to bail out U.S. farmers as the ongoing trade war has raised costs and hit U.S. exports of soybeans. Here with more about how farmers are handling tariffs is John Boyd Jr., National Black Farmers Association founder and president, as well as being a fourth-generation farmer himself. John, thank you so much for being here. Talk to me about the backdrop here. What is happening on your farm? What is happening on your members' farms?
Well, this is probably one of the worst times in history since the 80s that, farmers are losing their farms at record numbers. Farm foreclosures are up, farm bankruptcies are up, farm suicides are up, and the administration is slow to react. All of this chaos and havoc has happened to America's farmers within 9 months since the president announced tariffs on China and Mexico and other countries, where now China is beginning to buy soybeans from Argentina, and the president bailed them out with $20 billion. And we see it as that could have been a whole lot of relief for America's farmers. For the first time in a very long time, I was not able to secure a farm operating loan myself this year due to the bankers telling me that the cost per acre just wasn't working. As the young people said, the math wasn't math in here. And I was out here, so I'm basically farming from vendors, so to speak. So it's a very troubling time in America's history for America's farmers. And as we lose farm, there's the vice president who's out here buying land through his company, Acre Trader. All of these are happening while America's farmers are going under. The beef industry is at an all-time low, and now we're buying beef from places like Brazil. For the first time, we're importing eggs. We need to be investing in America's farmers and America's small farmers in this country.
And it's interesting at a time where the administration talks a lot about homegrown industry, right? Things like pharmaceuticals and semiconductors. Your argument that they should be investing in farmers as well. I want to dig into the math that's not mathing a little bit more, John.
Yes.
Talk to me about your input costs and what has been happening to them. And then on the flip side, what's happening to your sales prices in your end markets?
Well, the first time President Trump came in to office and announced his announcement for tariffs on China, I was selling soybeans in the United States for $16.80 a bushel. The price plummeted all the way down to about $7 a bushel. And now the president's in office again, and he's with his tariff war, and the price have plummeted right now again, hovering around $9 and some change a bushel. And farmers can't produce soybeans for that kind of price. My input costs, fertilizer is up, lime is up, seed is up. There's a labor crisis in this country where this administration cracked down on immigration for the very people who've been doing America's farmers hard work here. They're leaving this country due to the president's immigration policies. All of these are a recipe for disaster in American agriculture. And I can't figure out why this issue and this story isn't a top tier story. The president says something every day that tops what he says yesterday, and he's on there saying his tariffs are great. America's farmers are going to get money from the tariffs. We're not getting any money from the tariffs, people. A lot of those issues are tied up in federal court. The president frequently says he loves America's farmers, but he's letting us lose our farms at the auction block. Something is terribly wrong with this picture. We haven't been at the table. We have 160,000 members. Thank you for asking about our membership, 160,000 members. And I haven't had one invitation from the administration, from the Ag Secretary or the White House to sit down and have a real FaceTime meeting about the hardships of our farmers. And black farmers in this country, we never really got anything from the federal government. Under the first president's bailout for farmers, I think it was $25 billion. Black farmers were virtually absent from those numbers. And we have to find a way to make sure that all farmers in this country, when these taxpayers roll out these monies, are available and actually receive the funds themselves. Whether you're black, whether you're white, whatever your color is, we need the same amount of money. My cows eat the same amount of grass and hay as everybody else's, and my tractors burn the same amount of diesel fuel as everybody else, and we need the same type of resources as other farmers.
John, how much is riding on getting these bailout funds? How necessary are they for the farmers, and how much time will that buy you all?
Well, it's like putting a Band-Aid when you need major surgery. It's a partial fix, people. And I'm telling you that the United States is heading down the wrong path in America's agriculture. These skilled farmers that are losing their farms are leaving this career path with an awful lot of knowledge that we're not passing down to the next generation of farmers. And farming is a skill set that has to be taught. I'm a fourth generation farmer. I was taught to farm by my daddy, John Board Sr., and my grandfather, Thomas Board, and Lee Robinson, all invested time and effort to show me the skill set of farming. And I think I'm pretty good. I've been out here 42 years at it. We can't let these farmers leave this occupation and not tap the level of skill set. And that's a big mistake on behalf of this administration and the president. This isn't something that you just get out there and say you're going to help them and you like them and all of this stuff. This is something that has to be planned out. Your farming operation has to be planned out months in advance. It's not like a regular job, people. So it's it's the hardest occupation known to man. The work never ends. My hat goes off to any farmer that's out here doing it every day. And it's a shame that we're in the predicament that we are. with some of the lowest crop prices in history for corn, wheat, and soybeans. The three things that the United States still does better than anybody is produce corn, wheat, and soybeans. And the president used that to gamble on with the future of America's farmers. Now, I think it's a very shameful thing to do.
John, thank you so much for your perspective, and good luck to you. Thanks for joining us.
Support America's farmers, people. God bless you.
You too. Thank you. Well, let's get to a very different asset class. We're talking crypto. Bitcoin is edging lower today, but it has jumped more than 10% in just the last month, including touching 126,000 for the first time yesterday. So now what? When can we expect more crypto regulation? I'm joined by Andy Baer, Managing Director of CoinDesk Indices. Andy, great to see you. So, we've had this latest crypto push. I guess I should start with, what do you think has driven this latest leg up that's sort of now treading a little bit of water today?
Yeah, the last 6 months in the United States, I think, have been among the most important in crypto's history, right? If you look back 6 months ago, Ether was well below 2,000. Bitcoin was kind of recovering from the tariff tantrum earlier this year. We hadn't seen all the IPOs and the regulation pass and the sort of good news from the regulators. Since then, it's just been night and day. And not only Bitcoin, but the entire asset class has really sprung alive. About 50% of the crypto market's performance is attributable to Ether. So it's been a great broad rally. We now have publicly traded companies, cooperation between the SEC and the CFTC, listing standards for more ETFs. So it's just a real awakening, and I think investors are listening and getting more good top-of-fold reasons to allocate to crypto.
Well, and I think at one point, and you sort of pointed this out in your notes to us, at one point crypto was sort of the butt of some jokes, right? Or at the very least, a lot of skepticism. I don't know that that's entirely gone, but we're not, those conversations are fewer, certainly.
I just finished 5 days going to see a bunch of investors and managers throughout Europe, throughout a bunch of different countries, and it's really night and day. Everybody's taking notes. They're asking due diligence questions about things like custody and implementation and staking yields, really planning to allocate to the asset class. Some of them have Bitcoin in place either as a first step into crypto or along the debasement of the currency type of thesis, but they're all looking to go broader, and they're all looking for ways to sort of capture all this new good news that we're hearing about stable coins and tokenization. There's a lot fewer kind of eye rolls and smirks. There are a couple of smirks and eye rolls about the U.S. government shutdown over here in Europe, but certainly crypto is being taken very seriously, and it looks like a lot of money is about to go to work to add on to the record inflows that we've seen into ETFs over the last couple of weeks.
Well, and we've also talked about this other aspect before, but what about the sort of president and his family's involvement in various crypto businesses, which certainly raised some eyebrows even amongst those in the industry? Is that bleeding over? Are you seeing sort of any skepticism about that that's affecting how the industry is viewed overall?
There are institutions that have gained our trust over time, and the stock exchanges like the New York Stock Exchange and the regulatory bodies like the SEC and CFTC basically have led the U.S. financial markets to the dominant position that they have right now. And they've all taken steps, right, to engage with digital assets, to list publicly traded companies, to propose rules, to accept rules. So I think we're looking at the real progress. One of the quips in some of the meetings this week was, usually when you see this much regulatory progress in such a short period of time, right, you look over your shoulder and there's a giant financial crisis right behind you, and you're looking to mop up the mess. Not this time. This time, there's a lot of new solid rulemaking and engagement that is just in support of the asset class. So I think investors are focusing on the real progress that's being made. They're also waking up to how stablecoins are going to change a lot of the way we do things day to day and a lot of how the financial plumbing works. Those stablecoins need blockchains, and right now Ether and Solana are kind of neck and neck as the top two names to sort of win that prize.
And so it sounds like you think the momentum is just going to keep going, Andy.
The hills are alive. When I hear investors who guard and are the guardians of very sticky money and long-term allocations, and I hear the seriousness with which they're taking this, and realizing that, again, just 6 months ago, we were in a very different picture, but all the progress since then has been built on really making foundations for the asset class to flourish. I see a lot of building being done. At the same time, Bitcoin's store of value thesis is stronger than ever, given what's going on with monetary policy in the United States. And certainly momentum and sentiment are following that. So, we've also gotten through the first half of October all the way since the other record highs back in August. Pretty smooth sailing. So if anything, volatility is kind of a little bit low, especially for Bitcoin. But I think that, medium term, the market looks stronger than ever and better supported than ever.
Hey, Andy, for our viewers, can you explain the so-called debasement trade? And by the way, I feel like even us calling it the debasement trade is like me using the word fiat, right? It's like these DeFi-coded words that somehow have now made our way into the parlance. I mean, and we say them as though they're not loaded words. I mean, the word debasement is obviously a loaded word, but explain for our viewers what the debasement trade is all about.
I'm so glad you brought it up, Julian. Thanks for calling me out on it. I've started to use these crypto words that I, maybe that are new to me, and I'm using them like a tourist. But it was, in fact, like a Swiss private banker who used that word in a meeting with me, and so that's where I picked it up most recently. Look, people have worries about the strength and the dominance of the U.S. dollar, and you see gold hit 4,000 today for the first time. Gold's been on a tear since mid-August. I think it's the same idea that living in U.S. dollars, U.S. dollar dominance is something that some people feel is at risk right now. And so what do? Do you hop off into another fiat currency or another, sort of central bank supported currency, or do you find another source of hard money to store your value until you think that the dollar is going to resume its place as something whose value will be reliable? The dollar really hasn't had a year like this in my recent memory, and I think the last couple of months are raising concerns. So people are hopping into gold and hopping into Bitcoin as a way to store the value of their value. And if the dollar continues to weaken or even makes a more serious or volatile plunge, that people's value will be stored. So yeah, debasement's a pretty strong word, and maybe we shouldn't use it lightly. And I think there's a lot of talk in the press about Bitcoin being the debasement trade right now. But I just look at the price of Bitcoin, the denominator is US dollars. And if I feel dollars are going to be weaker and Bitcoin just maintains its value, the price should go up.
That seems to be a common belief in the crypto buying community. Andy, it's great to see you as always. Interesting to get that intel from Europe. Thank you.
Thanks, Julie. See you.
Let's get a check-in on shares of Oracle right now, because they're seeing a sharp decline after a new report from The Information that really highlights the financial challenges of renting out Nvidia chips. Now, the previously undisclosed data on Oracle's AI cloud business points to an industry-wide challenge. The big takeaway from the report, Oracle lost nearly $100 million from rentals of Blackwell chips in the most recent quarter. The company's banking on bigger revenue to offset profit margin decreases. Oracle generated around $900 million from rentals of servers powered by Nvidia chips and recorded gross profit of $125 million. So that's equal to 14 cents for every dollar of sales. Again, that's according to The Information. It's lower than the gross margins of many non-tech retail businesses. A spokesperson for Oracle, which doesn't publicly disclose the AI cloud server unit's financials, did not have a comment on those figures for The Information. The internal documents offer a rare glimpse into Oracle's dramatic transformation from a weak link of the cloud industry to an AI data center powerhouse. It also shows that being in the business of buying and renting out NVIDIA's graphics processing units is not easy. So those Oracle shares, obviously they've had a big up year, but right now they are trading down by about 5%. I'm also prompted to check on stocks like CoreWeave, which is in a similar business and also is seeing a leg lower. We'll have much more markets action ahead. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you'll see that all three major indexes have now flipped into the red. This comes as traders continue to digest day 7 of the government shutdown. The longer this drags on, the more it's going to impact those federal workers as well as those Americans who rely on government-funded programs. You see the Dow is down around 100 points. NASDAQ off around 0.7%, leading the declines that we're seeing. Then the benchmark index is down roughly 0.4%. Now, one thing that is not down today is gold. Gold just continues to tread higher here, now firmly above $4,000 an ounce, a new record. Year to date, gold is up a whopping 50%. This comes on the heels of a weaker dollar, and Americans may be hedging at the same time that they are risk on, because remember, equities have been trading at consistent record highs, and we did have a new warning from Citi out saying that there could be some profit taking as equities continue to experience these very high valuations. Now, Bitcoin is another asset that's been on the move this year, up 30% since the start of 2025. Trading right around $122,000 a coin. Again, this is around those record highs for Bitcoin. Now, if we flip back into the equity space and take a look under the hood of the NASDAQ 100, we do have some interesting movers. You'll see a lot of red on your screen. We have Nvidia shares off slightly. A lot of those Mag 7 players, Alphabet, Microsoft, Apple, Meta are all down today. You have Amazon trading slightly in the green. Also in the green is Netflix, up about 3%. Now, this comes after Seaport Research Partners upgraded shares to buy from neutral, also hiked their price target to $1,385 a share. That's up from the prior $1,230. And these moves to the upside also coming after a brutal 5-day stretch last week with Elon Musk calling on users to boycott the platform. So you are seeing shares up around 3%. And then year to date, taking a look at Netflix, we're up a whopping 35%. And then finally, if we take a look at a semis board, AMD continuing to extend those gains that we saw on Monday. Shares closed up 23% on Monday. We are up 4% today, leading to those year-to-date gains of just around 75%. But keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching IBM, Ford, and Plug Power. First up, IBM. Shares jumping after announcing an enterprise AI software pact with Anthropic. Big Blue will make the startup's Claude family of large language models accessible for its clients. Investors have been looking out for strategic partnerships between established technology companies and AI newcomers. Last week, the stock of Europe's largest software company, SAP, rose after it announced a deal with OpenAI to offer services to Germany's public sector starting next year. Those IBM shares are up 3%. Next up, Ford. The Wall Street Journal reporting the automaker faces months of disruptions to its business after a major fire at an aluminum plant in New York. The company will probably outline the fallout from that blaze when it announces quarterly earnings this month, according to the Journal. Ford's F-Series, the top-selling vehicle in the U.S., relies on aluminum from the factory in New York. A significant portion of the facility will be out of action until early 2026, according to that report. Ford is also the biggest customer of that plant. And finally, Plug Power, the company announcing a changing of the guard. Longtime CEO Andy Marsh, who engineered the company's transformation into one of the key players in the hydrogen energy industry, is moving into an executive chairman role. And Jose Luis Crespo, currently the chief revenue officer, will take over as CEO when Plug submits its next annual report, likely in March. Andy Marsh has led Plug since 2008, when the company was primarily known for supplying forklifts powered by hydrogen fuel cells. But in recent years, the company's been shifting focus to become an important supplier of both the gas and the systems needed to make it. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, all your markets action ahead. Our Jared Blickery, we're going to check in with him. You're watching Market Catalysts.
Uncle Sam is closed for business, but life goes on. On today's Stocks in Translation, we are breaking down the playbook for planes, parks, pantries, and portfolios, telling you the pain points and down the road where the dominoes might tip first. For planes right now, and let's bring up this chart here. For the planes right now, most airports are open and most flights are a go. But with TSA and federal staff unpaid, those peak hour lines, they can stretch. And national parks are still mostly open, but services are pretty thin. And when it comes to pantries, SNAP food aid should be on time in October, but WIC, which is aid for mothers and children, could tighten soon, depending on the state. And for your portfolio, yes, the Dow, S&P, and NASDAQ, they're at or near record highs, but the industry's watchdog, the SEC, is not reviewing deals, so the IPO pipeline, it's starting to stall. Now let's take a look at some of the heat maps of these effective industries, starting with planes. And I have these here. And this is going to cover the month of October, basically going back to the close of September. So right now we have airports open and pilots and flight attendants are getting paid. And you can see it's a mixed bag for the airline stock returns, but American is leading. And remember that traffic controllers and TSA are on duty but unpaid. This week should mostly hum, but the real risk arises after that first paycheck is missed. That's when fatigue and called-in sick days, they can spike and cause delays. And when those delays hit, we could get a meltdown that causes reputational harm to an airline. Now from runways to trailheads, and here we have the parks. They are mostly open right now, but services are thin. Visitor centers may have limited hours, but tours are paused and bathrooms, they might be closed or not serviced at all. If this lasts, expect more pack it in, pack it out, which means you'll be bringing in your own supplies and carrying out your trash. And we can see these stocks are another mixed bag, with Marriott, Expedia, and Hilton Grand Vacations in the green, while Booking and Airbnb are down. In general, check park status pages the morning of, not the night before. Next up, we are looking at pantries. And the good news is that October payments for SNAP, they should be on time. But WIC, which covers women, infants, and children, has a shorter runway and varies by state. The big retailers from Walmart to Costco will definitely be open. But if the shutdown drags on, infant formula will be the first pressure point. It's made by Abbott Labs, Nestle, and others. If benefit payments are missed, that could ding sales of big consumer staple companies like Coca-Cola, General Mills, Campbell. But the true cost will, of course, be shouldered by those left in need. And last up, let's talk now about investor portfolios. It's no secret that markets have been screaming higher with risk appetite pretty high, but behind the scenes at the SEC, deals are not getting reviewed. That means the IPO machinery is starting to slow, and just as IPOs have been picking up again this year. We've seen some big day one IPO pops from the likes of Klarna, Figure Tech, and Gemini Space, but investors might recall the late 28 shutdown, which delayed the Uber and Lyft IPOs by months. Those big bank tickers mostly in the red here, which is more likely to do with interest rates, but watch out for color commentary on the shutdown when JP Morgan, Goldman Sachs, and Citi report earnings on October 14th. Now, let's talk about what to watch next, and we've got a few items up here. A good rule for preparing for delays is to check websites frequently, as things can change quickly. For travel, look for TSA and airline updates. For parks, watch for status updates and closure notices, as well as travel booking notes. And for food assistance, watch for WIC updates and headlines on formula outages. If this drags into late October, that's when troubles heat up. And for your portfolio, don't read too much into the current price action, which is very risk-on. But do watch out for a slowdown in small caps relative to large caps, as well as for interest rate spikes and notices about IPO delays. The longer the shutdown drags on, the more kinks show up and get magnified. Tune into Stocks in Translation, the podcast. For more jargon-busting deep dives, new episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Gold ETFs recorded their largest monthly inflow ever in September, resulting in the strongest quarter on record. This as the price of gold notched 13 record highs in September. Joining me now, Joe Cavantoni, World Gold Council Senior Market Strategist. Joe, it's good to see you. So obviously it's been a good run here for gold prices and therefore the flow of assets into many of these gold ETFs. What is, as somebody who's been at this for a while, what sort of stands out to you about the magnitude of the move and the flows that we're seeing?
Well, it's a great question. And yes, we've been having an exceptional time in terms of the price performance for the last 2 to 3 years. This year in particular, what I think is really coming home to roost is what was mentioned on your previous segment about risk and uncertainty in the markets. You're now seeing a structural shift where countries and governments are laden with debt. Central banks are moving away from dollar and dollar-based assets as part of their reserves. And now you're seeing investors saying, risk and uncertainty on the horizon, harder than it's ever been for me to judge, manage. While I want to keep risk on, I need to find the right ways to diversify it. And that's where gold's standing out as an alternative investment, and that's where you're seeing the flows, and it's really picking up in the Americas.
Yeah, I mean, that's something that has been extraordinary to me, Joe, is that this idea that at the same time that equities can be rallying and reach record highs, the gold is seeing this kind of activity. I mean, do you think that it is that sort of hedging quality that's driving a lot of it, or what else do you think is going on as well?
There is 100% correlation between gold's uprising surge and that appetite for risk. For sure, investors understand that when you look to diversify your portfolio and they're looking at their bond behavior and their equity behavior and seeing those correlations at higher level than they've ever seen them. So they're looking for the right asset to diversify the risk they continue to want to take. And rightfully so, these numbers have been exceptional from a risk asset perspective. And where they see that benefit, that cost-effective benefit, is through the gold market. Now, look, their involvement is helping to move the price higher, but that's also in coordination with central banks that are also being big consumers right now and moving away from the diversification benefits of bonds, treasuries, and looking at gold. So there is big appetite. The asset allocation levels have been lower than we've expected to gold at about a 1.5% level. We're probably now getting to that point where we're looking at 2.5 into those higher levels where people should appropriately diversify. And you see that, like you said, 26 billion in flows in the ETF market in third quarter. You know, we've had record flows this quarter in terms of a month, and actually of September, and then a month, and I should say for the quarter for Q3. So it's just going to look to continue as people look for that right kind of diversification.
So nothing's going to stop this upward momentum, it sounds like you think, Joe?
Well, listen, I will qualify what I'm saying here that there is definitely momentum building into the price. You know, we've gotten to 4,000 and we touched it in the futures market, but not in the spot market. We're at 44 record prices year to date. There's definitely momentum there. So this is going to ebb and flow. But fundamentally, when you think about what's there, there's not a lot that's on the horizon for us to see a conclusion to the challenge and the problems and the economic uncertainty and the risks and the geopolitical tensions that's going to make us look for someone to say, it's time for me to unload my gold holdings right now. So we're looking at a new norm in terms of these price levels. And again, ebb and flow, momentum, speculation, trading activities, excitement around the 4,000 level. But look to see that this market gets held up simply because the fundamentals are doing so.
Do you have a price target, Joe? Are you in the business of making price targets? And if so, what would it be?
So we're not in the business of making a price target. We're in the business of helping people understand the case for gold. It's strong. But what I would say to you is that check the revisions that people are bringing out with their gold price projections, the large institutions that do gold, call the gold market, and they're all talking at that 3,800 to 4,000 level and sustainability of these prices. And that, I think, is the important factor that people need to understand. It might not be too late for you to get involved in gold because the case for gold's super strong.
Joe, good to see you. Thanks for joining us.
Thanks for having me.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.